We usually see debt as a bad thing, and it is. However, when it comes to the ultra-rich, they see debt as a good thing. In fact, they use debt to get richer. Wait, what? How do they do that? Well, if you're curious, then you're at the right place. Before we begin, I'd like to ask you to subscribe to this channel for more awesome videos just like this. Alright, let's dive right in. Well, the first way the rich use debt to make money is by margin investing. Margin investing, also known as margin trading, involves engaging in the buying and selling of stocks and other investments using borrowed funds. Essentially, it means that you're taking on debt to invest. When you encounter the term margin, think of it as borrowed money. This financial strategy allows you to utilize a margin account, typically allowing you to borrow up to 50% of the purchase price of the stocks you intend to buy. The remaining 50% must be provided by you, though variations like 80-20 are possible as long as you are the one who's paying the larger portion. It's extremely rare for a margin account to allow borrowing over 50% of the total investment amount. I know, it's a little confusing, so I'll give y'all an example. If you have $75,000, your broker may allow you to borrow an additional $75,000. You only had $75,000. However, you're now able to invest $150,000. But the question is, why would anyone do this? You see, the appeal lies in the potential for massive returns. For example, if you invest in a company with shares that cost $1,000 each, you get to buy 150 shares of the company. Now let's say that the price rises to $1,500. Now your shares are valued at $225,000, giving you a profit of $75,000. If you had invested just your own money, then you would have had 75 shares. Those would have been valued at $112,500, yielding you a profit of $37,500. But wait, you have to pay the money back, right? Well, you do, but in this case, you still make money. You see, margin loans typically carry an annual interest rate ranging from 6% to 8%. So let's average that out to 7%. You end up paying $5,250 in interest. However, you made $37,500 more, which brings your net profit to $32,250. You're still golden. But it's also crucial to recognize the risks. Since you are leveraging borrowed money to purchase stocks, you give some control to the lending firm. In unfavorable scenarios, such as a market downturn, the firm that gave you the money might sell your shares without consulting you. The concept is based on leverage, presenting both opportunities and risks. Successfully implementing margin trading requires careful strategy and tools to tip the scales in your favor. One wrong decision could lead to greater losses. Because at the end of the day, you have to pay the money back. So if the stock goes down, not only does your investment go down, but you also have to pay back the loan that you took. While margin trading can be a lucrative strategy employed by experienced investors globally, it is not recommended for novices due to its risks. Beginner's luck is possible, but the level of risk involved necessitates a high level of expertise for success. By the way, if you're enjoying everything so far, make sure to subscribe. Let's now talk about another way the rich use debt to make money: leveraged ETFs. An ETF, or exchange-traded fund, is an investment that works like a mutual fund and tracks a specific index, sector, commodity, or other assets. Unlike mutual funds, ETFs can be bought or sold on the stock market like regular stocks, offering a level of convenience. Traditional ETFs are considered safer because they pool investments in multiple companies. This diversification helps protect your money, as the impact of one company's performance won't wipe out your entire investment. However, it also means you won't see massive returns if one company performs exceptionally well. Now, a leveraged ETF is a financial product that uses borrowed money and derivatives to amplify returns. While a regular investor might make 10%, a leveraged ETF can potentially double or triple those returns. This is just like margin investing. Oh, and like margin investing, leveraged ETFs have risks. If the underlying index moves in the opposite direction, losses are magnified. The investor not only has to repay the loan, but also cover the losses and pay interest. This tool is commonly used by wealthier individuals to increase their income, but it requires careful consideration due to the potential downsides. Now let's talk about short selling. Another way to make money using debt is through short selling. Here's how it works. If you believe a stock is likely to decrease in value, you can borrow shares of that stock from someone, paying them a fee for letting you do that. Typically, you borrow the stock for a specific period, like 3 months. Once you've borrowed the stock, you sell it on the market. If the stock's price does indeed drop as you anticipated, you can buy it back at the lower price before the borrowing period ends. You then return the shares to the lender and pocket the difference as profit. While short selling can be a profitable strategy, it comes with significant risks. Regardless of how the stock performs, you must return the borrowed shares at the end of the agreed-upon period. If your prediction is wrong and the stock price rises, you'll have to buy it back at the higher price, incurring a loss. A well-known example of short selling risks was the GameStop Reddit saga, where firms with short positions on GameStop suffered substantial losses due to a sudden increase in the stock price. This underlines the potential volatility and challenges associated with short selling. Hedge funds are another way the rich use debt to get richer. Hedge funds are investment pools that consist of funds from wealthy people. Managed by professionals, these funds aim for high returns by employing unique investment strategies. Typically, they look for undervalued or overvalued securities and take either long or short positions based on their predictions about a company's future. Hedge funds often operate by leveraging borrowed money to increase their investment potential. For example, if an investor buys $2,000 worth of stock, putting in $1,000 of their own money and borrowing the rest, when the stock price doubles, their profits triple due to the use of debt. Although the investor must repay the borrowed amount with interest. However, like any investment involving debt, there are risks. If the stock's value drops significantly, the investor might face quite a loss. For example, if the stock price goes down from $2,000 to $1,000, then the investor has a total of $2,000 worth of stock. That's the same as what they invested, so not bad, right? Well, no, because they also have to pay back the $2,000 they borrowed, with the interest. While trading on margin allows investors to potentially earn more, it also exposes them to the risk of losing more than they initially invested. If all of this sounds a bit too tricky for your liking, you're not alone. This last way to use debt to make money might be a little more practical. You can always use debt to start or expand your own business. Leveraging debt to fuel business growth is a strategy used by many wealthy folks to get even wealthier. Sure, taking on debt has its risks, but it also comes with some pretty sweet benefits, especially when it comes to kickstarting a business with limited funds. Think about it. You've got a donut store and orders are rolling in faster than you can say success. The catch? You're struggling to meet the demand because your inventory and capital are both running on the low side. That's where the magic of a well-managed loan comes in. By getting some extra cash, you can swoop in, restock your inventory, and then use the profits to pay off that loan. What's cool about using debt in this scenario is that it gives your business access to funds it might not have had otherwise. This cash injection becomes a game changer, allowing you to invest in growth opportunities or handle unexpected expenses that could otherwise throw a wrench in your plans. Debt in this case is better because you're not handing over a piece of your business to someone else. No sharing ownership means you get to call the shots without the pressure of meeting someone else's profit targets every quarter. You have the freedom to steer your business ship in the direction you want without external shareholders breathing down your neck. Of course, we can't ignore the fact that debt can be a double-edged sword. But here's the key: proper management. When handled wisely, debt can be a powerful tool for individuals and institutions alike to ride the wave of success and build some serious wealth. So while it might not be everyone's cup of tea, when it comes to financial strategy, well-managed debt can be a game changer. If you enjoyed this, please give it a thumbs up and subscribe to our channel for more personal finance and investing-related content. What do you think? Do you know a way to make money using debt? Let us know in the comments below. Thank you for watching this video on how the wealthy make money using debt. Here's to becoming rich and financially free.